Hi, everybody, and welcome back to the Spotlight session in the next masterclass. And today we will be discussing all about depreciation, of course, with the lovely Amanda here next to me. And first and foremost, housekeeping as always. Amanda, over to you.
All right, super quickly, because I know that most of you have been here before. So we don't replace your broker and accountant. You still need your professionals. We are your strategic partners. But of course, your broker is your gatekeeper to finance and your accountant is your gatekeeper to tax. You need them. You need us alongside them, but please do not forfeit your professionals. What they say goes, because they are the ones there to protect you from the tax man and to get you the money that you need to do the things that we tell you to do. So, legal disclaimer, just to be clear, we're speaking to a broad audience. You're not the only person here. We have multiple people attending these masterclasses. So the level that we're pitching at is to what we have observed to be our general clientele and the questions that come up most frequently. Of course, a portion of that will apply to you and a portion of it may not. So please only take what does apply to you. If you want more nuanced or personalized feedback and information, then you can do that by booking in a call with Dragan. We'll pop up the QR code in a moment, but do take a moment to just have a look at the legal disclaimer there and be aware that this masterclass is pitched to a broader audience than the individual. As Dragan said, today we are here to talk about all things depreciation. Depreciation is a topic that comes up all of the time. We have so many questions from clients about depreciation. It's a very misunderstood tax perk because it has a lot of moving parts. So today's Spotlight Masterclass is designed to detangle a lot of those things. Now, of course, depreciation is a tax event. So the authority or the authoritative figure on any tax events pertaining to your individual circumstances is your accountant. The information that we are giving is general information about depreciation. Your accountant is the be-all and end-all when it comes to the tax man. Now, this masterclass works in tandem with our masterclass on CGT, capital gains tax. That's the other tax that we get asked a lot about as well. So if you're somebody that's struggling a little bit to wrap your head around all the tax implications and benefits of investing, these two masterclasses will be really beneficial for you because they'll help you detangle depreciation and capital gains tax so that when you do go to your accountant, you've got a fair idea of what you want to know more about, what to ask, how to structure things. You can have a more open conversation with them. So when you come to us, we can strategize in a more personalized way for your property journey.
That's right. And of course, guys, please book in a call if you have any questions. I'm happy to have a 15-minute discussion one-on-one with yourself, see where you guys are wanting, what you're wanting to do and what your goals are. You've got the QR code here, so scan that and feel free to book that session through with me or go to propertysessions.com.au/15. And hopefully we'll have a chat. A little bit about myself. So my background is parents from former Yugoslavia came to Australia as migrants in the 70s. I was raised in commission housing in an area called Redfern, which some of you may know, especially who are in Sydney. Grew up as one of those kids that, not have as much as what the other kids around me had. And I guess it sort of sparked a bit of a burning desire to then, have or aim to have more than what your regular person would. Anyway, in my early 20s, started my own photography business. At my early 20s also saved up for a deposit and got into property investing with the help of one of my landlords. The full story and the full masterclass, you can bog into that one if you haven't already. Anyways, so started investing in my early 20s. Fast forward to now, I believe I'm successfully doing it right.
It never came to the right.
I know. And also running my business. But I guess the main part of it is also educating my own children, as you can see the photos there, so they can have a strong mindset when they get to a mature age in investing in properties. So that education I'm forwarding to them and, of course, all my clients as well. Amanda, over to you, since I did that terribly. And I always do.
He's talking around himself. So I'm in the position of, I suppose, Dragon's children, where my parents educated me so that I would pursue property from a younger age. My mum was probably more indoctrinated, I guess, and my dad. My grandmother on my mother's side was very business minded. She was widowed at a young age, actually. She was in her 20s with 5 kids when she was widowed. So being ethnic, she was Italian, didn't speak the language. She was alone with 5 kids in a country that she'd only been in for, a short period of time. She had to learn very quickly how to look after herself. She did that through property investing and through other means as well. She had a farm. The 5 kids worked on the farm, mum being the youngest of the 5. And so mum and her siblings grew up very self-sufficient, very business-minded, very independent. They always had that mindset, you never know when you might end up alone, like their mother did. So they all became very self-sufficient, very driven, and very, business-minded. So a lot of influence comes from my mum in terms of start young and line up your ducks, because you don't know what's going to happen in life. Anything can happen. And then my dad's background, also Italian, but more, I suppose, slow and steady. His parents were, sort of basic income earners. They did invest, not a lot. Dad, like Dragan, wanted a better life than that. He wanted a bit more security and a bit more assets to his name. So he invested a little bit more aggressively, but didn't have the encouragement or the support that mum had. Mum had more of a push than dad, but dad still did very well. So when they met, they joined forces, and they instilled in us kids the benefit of starting young. I'm very much my mother's daughter and my grandmother's granddaughter, in the sense that as the female, there's that drive to, I am married with kids, but there's that drive to, be self-sufficient in the sense that I'm responsible as well for this journey. I'm not just a passenger in the marriage or a passenger in life. So for me, property investment is a huge passion. It's something I started at the age of 21 with that push from my parents. If you watch the other master classes, some days I'm more positive, some days I'm more negative about their influence. Some days I call it coercion, some days I call it encouragement. Depends what mood you get me in. Today I'm being positive, apparently. And of course I met a like-minded partner as well. He and I actually met in a property forum. So that helps as well. So our journey sort of snowballed, because once you join forces with someone and that compounding starts, it certainly helps. So professionally, my background is in English teaching. I then had my kids. I didn't go back to teaching. I ended up here to pay it forward and hopefully pass on knowledge to all of you guys.
Okay, Amanda, what is it? What is depreciation?
Depreciation, that is a big question. That is loaded.
And it's a big topic, but
Massive.
yeah.
But we're going to try and condense it down, because, as I said, this is very much an accountant topic. But if we give you enough information to give you a basis of knowledge so that you can have really valuable conversations with your professionals, then it will help you.
Yeah, and it's important to actually understand, to have a good accountant and what I call a
Yes.
team. Your accountant, your conveyancer, your property investment advisor, or who, that group is very important. Now, for some of you out there that say, oh, geez, I don't have this. This is beginning stages for me. We can assist there as well. So
Yeah, having the right team that give you the right advice can speed up or slow down.
100%, 100%.
Yeah.
Yeah.
All right. So what is depreciation? It's a tax benefit that lets you claim deductions for natural wear and tear of your property. So the idea being is that a property, as in built structure, not property like land, the built structure has a lifespan or an expected life expectancy. Expected life expectancy. I was a great English teacher, can you tell? Expected life expectancy of 40 years, meaning that with wear and tear, we expect a property in original condition to last 40 years before it requires renovation or
Yep.
I was going to say deconstruction, demolition.
Demolition, yeah. That's it.
Oh my goodness, demolition. So if we divide that 40 years across 100%, that's 2.5% every year that property diminishes in value. So for example, if a property is worth $600,000 to build new, and when I say property, I mean built dwelling, just
Not
like
land.
if it's worth $600,000 build cost, then 2.5% of that is $15,000. So $15,000 every year for 40 years is what we expect that property to depreciate by. And just as the cost of making money is tax deductible, that $15,000 is considered a cost. Therefore, that cost comes off your taxable income every year for 40 years. So the cost of making money is tax deductible. Depreciation on the built structure is considered a cost. You're not paying it, it's a theoretical cost, but the tax man considers it a cost. So that cost is deducted from your taxable income every year. Now, if you're purchasing new, if you're building or developing yourself, you have that build contract to, I suppose, substantiate the cost of that built dwelling. If you don't have that, if you're buying a property that is established, then you hire what's called a quantity surveyor to create you or to prepare for you a depreciation schedule. So they'll assess all the components of that property and then they'll work out what that cost is, that wear and tear cost is each year for the remainder of the 40 years lifespan of that property.
Yeah.
Have I missed anything in that explanation?
No.
We're all good?
No, we're all good.
Because my brain sort of went a bit wild there. Okay. So depreciation on new properties, we'll start with new properties first. How does it work on brand new or off the plan? So there are two types of depreciation that apply to brand new properties. And the reason that I want to address this first is because a lot of clients come to us with the belief, or they phrase their questions to us in a certain way where they believe that the first owner of a property has more depreciable benefits than subsequent owners of a property. And we've been trying to work out where this is coming from and why they have this belief. So part of that comes from, just if you let me briefly
Sidetrack.
divert a bit.
Yep.
Part of that comes from, if you're buying direct from a developer, there's a two-part contract, the land component and the build component. And sometimes they can drill down the price of the land to save you stamp duty / save the developer capital gains tax. And then to make up that shortfall, they pump up the price of the build contract because there's no capital gains tax on a build contract. So they put some of that money on that. And then because of that, your 40 years, your 2.5% per year gets bigger because they've inflated the cost of the build contract to make up the land, blah, 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 blah. If you watch our other Spotlight Masterclass and our big webinar, our big 2.5 hour one, we go into more detail with that in those. But that's one reason we found that people were coming to us with that. They were talking to other buyers agents or other companies where it's buy direct off the developer. And that's why, as the first purchaser, they were getting more of a benefit because they were artificially inflating the build contract prices to drill down the land component price to save stamp duty, which is really saving capital gains tax for the developer. But then there's also another thing that may come into play. It's less of an advantage for the first owner, but it's possibly why we're finding so many clients coming to us with this question. So I want to address that on this slide. The first thing we talked about is the capital works deduction. So that 40 years, 2.5% per year, and that applies to your construction costs. So the built structure, okay? So as I said, a $600,000 construction cost is $15,000 a year in depreciation, and that applies on new properties, established properties, any properties. So if you buy a property that's, 20 years old, that quantity surveyor will look at that property and go, okay, well, if this is 20 years old, 20 years ago, what would it have cost to build? Oh, but they've renovated the kitchen, so I've got to account for that extra cost. You know, they work it all out and they give you the remainder of the time, the balance of that.
Yep.
There's another aspect of depreciation that applies only to brand new properties if you're the first owner, and that's plant and equipment deduction. So if you are the person on the build contract, if you are the person that has made these purchases directly, then the ATO will recognize certain, not all, certain fixtures. So for example, if you're building a home with the example there is a $3,000 air conditioning unit, if you put in a nice, ducted aircon $3,000 system, then they will recognize the effective life of that system. So for example, if an aircon unit is expected to, or have an expected life expectancy, I'll use my good England again. an expected life expectancy of 10 years, then they'll depreciate the value of that over the 10 years. So the $3,000 aircon, over 10 years, 10 years divided by 3,000, you get your 300 depreciable amount in addition to your 2.5% per year. Okay. Once you sell that property, then the second owner who didn't purchase that aircon unit doesn't get that plant and equipment deduction. Now, yes, it's a perk for the first owner, but it's not that much money. So a $300 a year tax deduction on an aircon unit, if you're in a 30% tax bracket, it's $100 a year, right? Now, you're purchasing brand new, which means you're paying a premium for that property because the developer's making the profit, not you. You're buying at the top of the growth cycle for that property. That's not worth $100 a year cashback, which is essentially what depreciation is. The better cashback is buying established and negotiating way more than that.
That's right.
On your entry price.
Yep.
Okay. So just be aware that you're not using tax benefits to justify overpaying for properties at the top of their growth cycle.
Yeah. Anyone that's selling with tax benefits, you should question.
Yeah. So if you look at our other spotlight masterclasses on buying new versus buying established, we talk about that growth cycle and how purchasing new, there's no value add opportunity. You can't renovate, you can't subdivide, you can't do anything to value add. You're buying at the top of the growth cycle, and then you've got to wait for the property clock to run its way back around again to get any growth or equity.
Yeah.
So be aware, because we have been scratching our heads trying to work out where this first owner benefit line that clients come out with come from. The best we can come up with is they're inflating build costs to drop down land costs, or it's this plant and equipment deduction. But again, they're not reasons to invest. They don't stack up. So watch the other spotlight masterclasses on new versus established, because we go into depreciation there. But also here, know that yes, there are two types of depreciation, or two categories of depreciation, where one of them does apply specifically to the first owner, but the value of that component of depreciation is low. The 2.5% on the total applies on any property or any renovations on that property less than 40 years old. You get those no matter which owner you are. Things like the depreciation on fixtures such as aircon units, yes, only apply to the first owner, but they're worth not much, not worth enough to overpay for the brand new tax.
That's right. Yeah.
Brand new premium price.
Definitely. Depreciation on old properties. How does this work, Amanda?
Yes. So you still get depreciation on established properties if you're not the first owner. So as I said, you get a quantity surveyor and you order a depreciation schedule. Anything under 40 years is depreciable at a rate of 2.5% per year for the balance of the 40 years. So for example, it applies to the construction cost at the time of construction. So that quantity surveyor will look back at, okay, so at the time of construction, what would the build contract price have been? So then they look at, 2.5% of that, okay, the house was built 18 years ago, 22 years left at this rate. Okay, the bathroom's, been renovated, the kitchen's been renovated. Bathroom was renovated 5 years ago. It's a $15,000 bathroom with 35 years left on it at 2.5% P. So then they'll add that as another item on the schedule. They'll look at the kitchen. Like, the kitchen's only a year old. The vendor did the kitchen up for selling. They spent $50,000 on the kitchen, 2.5% per year. We've got 39 years left on the kitchen. They'll add that as another item on the schedule. And then they'll give you, the 40 years, year 1, depreciable amount, year 2, depreciable amount, year 3, depreciable amount. That comes off your taxable income per year because, like we said, the ATO recognizes it as a cost, not a cost that you are physically paying, but a cost of owning that property, because they recognize that the built structure depreciates. The investment, the value of the investment is in the land. The land is what goes up. The land is what is scarce. What is built on that land is simply your means of generating income. But that built structure, wear and tear, depreciates. So if you get that depreciation schedule, then you know what your deductibles are each year off your income. Now, capital works are deductible as well. So any renovations, anything that you do that is not maintenance and repairs, anything that adds value to the property. So if you've got an old brick house and you decide to cement render it, that counts. Okay. Yep. Anything that adds value to the property gets added to that depreciation schedule. So if ever you do work on a property, you're doing your kitchen, your bathroom, get a new depreciation schedule done because your deductible will go up. Okay? So you can claim depreciation on any property or any renovations on a property under 40 years old. So even if the bones of the property, the structure is 50 years old, but the internals have been entirely redone, those are depreciable as well.
Yep.
Any questions there, or are we okay?
No, we're good.
We're good?
Yeah, 100%.
Okay. So how to use depreciation to your advantage? Is there a way to get the best of both worlds? Is there a way to get the full 40 years without paying a premium to purchase brand new? Is there?
Of course there is.
There's always a way. Where there's a will, there's a way, right? Okay. So buy new or buy old? Buy both. So what you can do, this is what I would do.
Mm-hmm.
You buy a 30-year-old property. 30-year-old properties, a little bit run down, you might purchase them a little bit closer to land value because they're not new and shiny. They, might have a dated kitchen, dated bathrooms, old ugly carpet. 30 years old, okay? Purchase close to land value. The great thing about that is you're not paying a premium for the built structure being new and shiny, but it's still good enough to earn you a rental income for the next 10 years. You might chuck in some cheap carpet if you want to, maybe paint it. But it's got a good 10 years of life left in it with that income generating from it, okay? You collect rent from day one. Whereas if you're purchasing off the planned or house and land, particularly house and land where you've settled on the land, but then you've got to cover the cost and time of construction, you're paying holding costs with no income. This one, you're making income from day one. So your holding costs are covered or partially covered from day one.
Yep.
You claim the last 10 years of depreciation. Remember, if you do paint and carpet or kitchen or bathroom, cheaply, that depreciation schedule will cover those at the 2.5%. So you claim the last 10 years of depreciation. In 10 years, we would expect that property to double in value. That rental income has helped you hold that property. Okay? So in 10 years, the property doubles in value. You've now got enough equity in that property to refinance and draw out that equity. When you draw out that equity, that covers the cost of a knockdown rebuild. Mm-hmm. So you don't have to manually save another deposit to go and purchase another property. You can improve this property to pick up those benefits that you want. So you refinance and you knock down rebuild. Now you might build a duplex. You might want 2 incomes. You might build a brand new home and flip it if you want to, or you might subdivide, build 2 homes, keep one, sell one.
That's right.
One might pay for the other.
It's one of our strategies.
It is.
Mm-hmm.
Now, you can claim full depreciation benefits for a new build. Remember I said there were 2 types of depreciation benefits and people love the idea of both because they want to be the first owner. Well, guess what? Now you are the first owner because you're the one that built it. So you get all that depreciation that you want, but you've still done the 2-part contract. Remember I said earlier, the developers will sell you the land and then, you got to do the build and they sort of muddle up the numbers and whatever. Here, you're just committing to the cost of the land. It's producing income with the older house. When you're ready, when it's affordable, when the equity is there, then you commit to the construction loan because remember, you've got to cover the holding costs during construction.
Yep.
So you maintain control of the timing and you do it at a time that is right for you when you are ready to cover those costs. You haven't just taken out a big mortgage on a new purchase and then you've got to cover the costs. Leave it for 10 years. You've got a bit of equity there to fall back on if needed. So you do your KDR, you knock down rebuild, you collect your 2 incomes if you've done a duplex or your 1 income if you've done a house. You've got all that depreciation that you wanted in an established area rather than a house and land package area where you're buying cookie cutter. Again, look at our other Spotlight masterclasses on new versus established. You've got something in a better area, probably on a bigger block of land. You're still getting all your benefits. You've used equity to pay for it, which means you've saved a smaller deposit at the beginning because you bought in at land value 10 years ago. And you're winning. There is a way to do both. To know that that's an option, as we said earlier, you've got to access professionals that give you good advice because the cost of bad advice, it's not monetary, it's opportunity cost. It's opportunity cost because it's tying up your money in things that haven't or don't have the potential to expand and grow your wealth in the quickest, most efficient way. So this is a way to use depreciation to your advantage because anything under 40 years offers it to you. So you're better off buying older homes at land value, replacing them at the end of their lifespan with newer homes, and then you get to double dip and get the best of both worlds.
That's right. Things to be aware of.
Yes. So people often choose depreciation for cash flow reasons. So a lot of clients that come to us will go, oh, it's negatively geared, but then I get the refund back and all the depreciation back at the end of the financial year. That can be the case depending on what you've purchased and how you've structured it. But if you are negatively geared through the year, you still have to carry that cash flow, that negative cash flow out of pocket. You still have to have the income and the cash there week to week, because that whole year, it takes a whole financial year to get that tax return. So can you stay afloat? Can you stay liquid? Can you remain up to date with your repayments until that tax return comes in? And even then, the tax return won't cover the full amount. You're only getting the tax back. So if you're in a 30% tax bracket, it's only covering 30%. The other 70% of that shortfall is still on you. So you've got to be really careful that you've done your numbers properly, and that when they say to you, wherever you're getting this information from, oh, you're only $100 a week out of pocket after your tax return. Okay, but what is it before your tax return? Is it $200 a week? So you've run your numbers on $100 a week when it's actually $200 a week. Be really careful, again, that the information you're being given is in your interest. It's not a sales pitch. It's about education. We're here for it. I'm a teacher. Ethically, I'm here as a teacher, not as a saleswoman.
And that's why she's doing most of the talking as well.
Yeah. And if you didn't let me, I wouldn't be here, because it's against my moral code, right? I'm not here to sell you stuff. I'm here to give you information, because my job first and foremost is a teacher.
Yep.
Okay. So make sure the information that you get is in your interest and isn't packaged in a way to influence your decision making. And that's why I said at the beginning of this masterclass, your accountant and your broker are the be all and end all. They are your gatekeepers. We are just your strategic partners.
Yeah, be wary of people who try to sell you any sort of packages with their internal accountants and brokers. So just
Well, any recommendations we make, we obviously fully disclose those. It's not in-house, because then you have a conflict of interest. It's got to be as independent as possible, so that you access the most unbiased information for your needs as possible.
Yep.
Okay. So you've got to be able to carry the negative cash flow, so you only get the deductions back at tax time. Cash flow, therefore, might be heavily negative until tax time. Can you cover these costs, compared to buying cash flow positive and KDR later? Okay, which was the strategy that we set.
Okay. Again, guys, you've got the QR code here, so please book your 15-minute discovery session with myself. If you have any questions, you need a discussion on what you want to do, where to start, or even if you're already a seasoned investor and want to take the next steps and not sure where to go, QR code here for a 15-minute discovery session with myself. I'm repeating myself again. Or good England. Or just go to propertysessions.com.au/15, and hopefully we can have a chat. And thank you for coming on to this spotlight session. Amanda, thank you very much, and we'll see you on the next one.
See you there.